In today's episode, we'll break down two important stories. First, we'll talk about the world's energy transition meeting a historical crisis, and then we'll talk about the opaque curtains of India's gold pricing. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara, and today is Thursday, 9th April. Before we start, we want to tell you about a new project we've started, Subtext by Zerodha. Our work at the Daily Brief or elsewhere at markets doesn't often involve talking to experts and scholars that we think people should know about and even refer to in our stories. Subtext is our way of literally engaging with the rest of the world, and it'll house conversations and narratives with incredibly knowledgeable guests. Think entrepreneurs, policymakers, academics, and industry experts. Our first episode is out, and it's with Manoj Keval Ramani, a China Studies Research Fellow at the Takshashila Institution. It's a scintillating, myth-busting chat with someone who doesn't just read about China extensively, but has actually lived there and speaks the language. You can watch this episode on YouTube or listen to it on Spotify or Apple Podcasts or read the transcript on Substack. With that, let's get on with the show. Coming to the first story. So what happens when an unstoppable force meets an immovable object? In this case, we're referring to the world's energy transition clashing with the crisis at the Strait of Hormuz. We leave you to decide which is which. So Fatih Birol, the head of the International Energy Agency or IEA, calls this crisis the largest supply disruption in the history of the global oil market. For many of the world's developing and poor nations, which are mostly wholly dependent on crude oil imports, energy diversification has never been more important. The good news is that the shift away from fossil fuels and towards renewables and nuclear has been progressing consistently across the world. And perhaps with how this crisis is spiking the price of crude oil, there's an explanation that the transition will only accelerate further. But there is an important caveat to this. Progress has not been uniform across countries, and the Hormuz crisis is interacting with the world's current energy mix in complex ways. So right now, clean energy does not have a clean, rosy story. The crisis has simultaneously accelerated the shift away from fossil fuels and temporarily reversed it in different places for different reasons, often at the same time. That's what our story is about. Now, for many countries, the energy transition has depended on a crucial intermediate step, liquefied natural gas or LNG. The theory was sensible enough. For power, coal was the primary source, and full renewable grids would take decades to build. LNG was meant to serve as a bridge in between. While being a non-renewable energy source, it's much cleaner than burning coal and would help reduce emissions while solar and wind infrastructure were being built. Japan, for instance, had committed to this more fully than almost anyone. After the Fukushima nuclear disaster in 2011, it shut its nuclear reactors and rebuilt its power system around imported LNG. Taiwan and South Korea followed similar paths, and all three entered 2026 deeply reliant on a few LNG suppliers, especially Qatar. However, the crisis disrupted Qatar's supply of LNG and raised its prices. Now, this bridging strategy makes far less sense. So the immediate response across Asia was a reversion to coal. Japan lifted operating restrictions on older coal plants for up to a year, while South Korea removed its 80% cap on coal-fired generation. Meanwhile, Indonesia, the world's largest coal exporter, is actually prioritizing domestic supply, redirecting coal towards its own power plants rather than exporting it. Europe is in a different kind of trap. In their chase of achieving a renewable heavy grid, some European nations have fully phased out coal. They doubled down on LNG and diversified their sources after Russia's invasion of Ukraine in 2022, importing from Qatar and the US. However, Europe entered 2026 with abnormally low gas stockpiles. Now you might wonder, this is just temporary. If, and that's a big if, this crisis ends, countries could just switch back to LNG. Right? It's not that easy. Coal plants are not designed for flexible operation. They're built for steady, continuous baseload generation, not to be switched on and off in response to a geopolitical crisis. Repeatedly ramping them up and down causes thermal stress, reduces efficiency, and drives up costs in ways that compound quietly. More problematically, new coal capacity locks in asset lifespans of 30 to 40 years. Emergency choices made now could make a long-term impact on the carbon profiles of these economies in the future. Now, India's relationship with LNG was always more fraught. As we've covered before, imported LNG was never cheap or reliable enough to compete with domestic coal and renewables in the Indian power sector. As a result, our transition has been more of a direct jump from coal to renewables. And this is partly why India is accelerating coal gasification, where domestic coal is converted into a gaseous form that's easier and cleaner to burn than real coal. Now that we've addressed the middle layer of the energy transition, what about the final phase? Clean energy itself. The crisis has produced a strong price signal for clean energy alternatives, and in many markets, those alternatives are now mature enough to respond. In India, electric car registrations jumped from 50% year on year in March, and some part of the jump in recent EV bookings is attributed to this crisis making petrol cars relatively more expensive. And industry analysts expect that this is just the beginning. A report by Amber documented that Vietnam had already hit a 38% EV sales share, Uruguay 27%, and Indonesia 15%, all ahead of both the United States and Japan before the crisis had ever begun. China leads the pack, crossing 50% EV sales share for the first time last year. Now, many of these countries provide consumers with tax credits and subsidies for EV adoption. But even in countries that lack them, EV adoption has taken off in reaction to the crisis. Ironically, no country illustrates this better than one of the central actors in this crisis: the US. See, the Trump administration ended the federal EV tax credit last year, making new EVs far more expensive for the average American. As petrol crossed $4 a gallon, consumers pivoted to the second-hand market as used EV sales surged 12% from last year. Now let's move on to solar, which has already been enjoying strong tailwinds. As per Ember, even prior to the crisis, solar power generation has pretty much been doubling every 3 years. The biggest appeal of solar comes from the fact that it's a terminal product. So, what that means is, unlike a gas fired power station that requires you to pay for fuel every day it operates, a solar panel generates electricity for years at zero ongoing fuel cost. There's no cost for the sun. Across Europe, a boom in balcony and plug in panels saved the continent approximately 100 million euros in March alone this year just by displacing demand for imported gas. Only recently, a developer in Vietnam recently asked the government to cancel a planned LNG terminal and build a solar and battery project in its place instead. Perhaps the solar story hasn't been more powerful anywhere else than in developing nations that adopted it out of economic desperation. Pakistan, for instance, imported roughly 41 gigawatt of solar panels from China since 2023, nearly equal to its entire pre-existing power generation capacity combined. Sri Lanka, meanwhile, was just recently burnt by a foreign exchange crisis driven by fuel import costs. As a result, they've been rushing solar and battery projects to manage the current energy hardship. Lebanon, where grid power has been rationed, has seen rooftop solar spread across their country. Now, solar is not fully insulated from the crisis. There are two big bottlenecks, one of which has directly been created by the Hormuz crisis. See, solar panels use a lot of aluminium, which is energy intensive to smelt, and smelters in the Gulf, where power is cheap and abundant, make up approximately 9% of global aluminium production. Now, they have curtailed output because of the same gas shortages hitting everyone else. Aluminium prices were already rising before this, but now they've hit 4-year highs. The crisis is briefly making solar a little more expensive to build at exactly the moment it should be the most attractive to buy. The second catch has more to do with how solar itself is being adopted. In countries like Lebanon and Pakistan, which we covered earlier, solar panels are mostly being adopted by their richer citizens. Often, it has no connection to the national grid, which is pretty much collapsed. The large, relatively lower income sections of their societies, which are still reliant on the grid, are still facing the brunt of the Hormuz crisis. Meanwhile, nuclear might be having a huge dramatic political moment. The crisis has driven countries which had sworn to never take up nuclear again to announce new nuclear plants altogether. Taiwan, for instance, promised a nuclear-free homeland in 2016, decommissioning its last nuclear plant last year. But now, in a complete reversal, they might be restarting 2 shuttered reactors. Meanwhile, Japan is also turning back on some of its reactors. Across Asia, nuclear is being reframed from a politically toxic legacy technology to the only firm baseload power source that doesn't depend on imported fuel or sunny skies. Of course, when we talk about clean energy sources like EVs and solar, it's hard not to wonder about China's role. After all, China produces most of the world's solar panels, dominates EV battery manufacturing, and also controls rare earths that feed both technologies. The supply chains of the clean energy transition run almost entirely through Chinese factories. A country scaling up solar and EVs is, in effect, trading dependence on Gulf crude for dependence on Chinese manufacturing. With EVs, the danger is more obvious as countries are likely to import not just EVs from China, but also batteries and the lithium that powers them. However, with solar, some argue this is not the same vulnerability. When you buy a solar panel, you buy the means of production. The leverage China has over your energy supply should end the moment the panel creates power. But that's not the only geopolitical leverage China has. In this crisis, it might also be one of the most energy secure nations in the world today. As per the IEA, the oil displaced by China's EV fleet last year was roughly equal to what the country imported from Saudi Arabia. Its power grid is mostly powered by coal and renewables, insulating it strongly from global oil price shocks. On top of that, less than 20% of China's oil imports are from any one source. It also has 1.2 billion barrels of crude in onshore storage as of January, roughly 108 days of import cover. Coal, though, remains the ballast stone of China's own energy security, accounting for over half of its electricity generation. China is simultaneously the world's biggest clean energy manufacturer and its largest coal consumer. Those two facts coexist without contradiction, but they mean different things for different kinds of dependence. So prior to today, the last big oil shock was in 1974 when OPEC hiked oil prices. Up until that point, our entire mass production economy, cars, suburbs, plastics, synthetic fertilizers had been built on the assumption of cheap oil. Economic historian Carlota Perez studied this crisis and realized that when oil became expensive, the search for the next cheap input intensified. She found it in the rapidly falling cost of microelectronics, which in turn gave birth to the age of information technology. This was a new industrial revolution that came partly as a response to expensive energy. History doesn't rhyme, but does it repeat itself? Will the oil crisis of today accelerate the clean energy revolution? Will it fasten the advent of what people call peak oil? There's certainly a huge impetus. Countries are enforcing work from home policies, ordering AC temperatures be raised, introducing 4-day work weeks, and even closing schools. Perhaps the feeling couldn't be more succinctly put than when Lee Jae-myung, the president of South Korea, said this. Right now, there is chaos worldwide due to energy issues. Frankly, the situation is so serious that I cannot sleep. South Korea must swiftly transition to renewable energy. Now, the transition itself was always complicated before the Strait of Hormuz blockade. But now that has made things even messier. Yet, it's made the call to action far louder than it's ever been, and that itself could be the biggest catalyst the new energy shift needs. Coming to the second story. On April 1st, the Directorate General of Foreign Trade restricted all imports of gold, silver, and platinum jewelry into India, effective immediately. The next day, a second notification restricted precious metal alloys, certain forms of unwrought gold and silver, and several other categories under Chapter 71 of the Tariff Code, also effective immediately. The language was unusually aggressive. No transitional relief, grace period, existing contracts, irrevocable letters of credit, advance payments, goods already shipped, all overridden. The government does not talk like this unless it believes something is urgently, structurally wrong. India produces almost no gold of its own. Every year, the country imports roughly 800 tons. For India, this fiscal year, gold was the single largest item on the import bill after crude oil. In October 2025 alone, gold imports hit a record $14.72 billion, enough to push the monthly trade deficit to an all-time high of $41.7 billion. And between the import price and the gold you buy, there sits a small, closed group of intermediaries operating through a system so opaque that different buyers routinely pay different prices for the same gold on the same day. This is the story of how that system works, who benefits from it, why the government keeps trying to fix it, and why it keeps failing. Now, for most of independent India's existence, importing gold was simply illegal. The Gold Control Act of 1968, introduced by Finance Minister Morarji Desai, prohibited citizens from owning gold in bar or coin form. Goldsmiths couldn't hold more than 100 grams. Licensed dealers were capped at 2 kilograms. The reasoning was that India's huge appetite for gold was draining foreign exchange reserves at a time when the country could barely afford to import essential goods. Although it killed the official gold market entirely, a massive underground market replaced it. Gold was smuggled in from West Asia on dhows, landing at secluded spots along the western coast. The men who ran this trade became Bombay's first organized crime bosses. Haji Mastan was the master of the Arabian sea routes. Dawood Ibrahim got his start as a landing agent, receiving shipments on the docks. By 1990, the broader economy was in crisis. India was on the very edge of defaulting on external obligations, and the government pledged 40 tons of gold to the Bank of England to secure emergency loans. The Gold Control Act was repealed. Liberalization followed, and gold imports were legalized at a specific duty of Rs 300 per 10 grams, roughly 1%. Smuggling became uneconomical overnight. But gold couldn't be entirely decontrolled either. Unlike oil or machinery, gold doesn't fuel production, and the foreign exchange used to buy it is gone. You cannot simply place an order with an overseas supplier even if you have an import export code. Ideally, you need certain regulated entities at the center of India's gold trade. And that's what the RBI did. In 1997, the RBI designated the first batch of 7 banks as nominated agencies for gold import. They would directly buy gold from international suppliers and sell it to jewelers at a markup. Then, in 1998, the RBI issued a circular that expanded the ways nominated banks could import gold. It added several new options, including something called consignment. Now, under consignment, an overseas supplier, typically a global bullion bank like HSBC, JP Morgan, or a Swiss refinery, ships gold to India through a nominated bank. But ownership does not transfer. The gold sits in a vault in India, still belonging to the foreign supplier. And the nominated bank is not a buyer as much as it's a custodian or middleman. The gold stays in this state physically in India but legally owned by a foreign entity until an actual end buyer, like a bullion dealer or jeweler, shows up. At that point, the nominated bank facilitates the sale, and the price gets fixed only then at the moment of sale, not when the gold was imported. Now, the nominated bank in return gets a fee on each transaction. It doesn't need to deploy capital or take price risk or fund the inventory or even bear the storage cost. Almost all gold imported into India comes through consignment because for the banks, it's risk-free income. But obviously, that means that these banks have negligible say in how gold is priced. As per a paper from IIM Ahmedabad, the consignment model has made nominated banks overly reliant on suppliers setting prices for them. Most banks have not advanced up the value chain by holding gold in their books, even though the RBI has explicitly permitted them to do so since July 2014. The banks found a comfort zone where a simple markup is added to run their bullion desks, and they've stayed there ever since. As of July 2025, there are exactly 16 nominated banks, including State Bank of India, HDFC Bank, ICICI Bank, and so on. On top of these banks, there are also 43 refineries certified by the Bureau of Indian Standards that can import unrefined gold for processing, and a few government agencies. But the banks are the primary channel through which gold passes into India. Okay, but is there a problem here? Yes, there is. See, when a bullion dealer wants to buy gold, they call their contact at a nominated bank. The bank checks with its overseas supplier and a price is quoted. That price depends on the size of the order, the dealer's relationship with the bank, the timing, how much gold the supplier currently has parked in Indian vaults, and the dealer's negotiating power. Every transaction in this system happens privately, bilaterally, over the counter. There's no exchange where bids and offers are visible, no centralized order book. This means there is no transparent, publicly available price at which gold changes hands in India. So, a large dealer in, say, Zaveri Bazaar, who moves hundreds of kilograms every month, who has dealt with the same bank for 20 years, gets a different quote from what a regional dealer in Varanasi or Coimbatore gets through an intermediary. The nominated banks have been offering different prices to different customers. And this is why gold prices in India vary from city to city. Each city has its own bullion association that sets a daily gold rate every morning, and local jewelers price off that rate. But these visible city level differences are just the surface. Underneath them lies a supply chain where the spread between what the foreign supplier charges and what you eventually pay passes through multiple links. And each link adds a markup that's set in private, making the price a lot higher than what would have existed with a central exchange. Now, India has indeed built such an exchange. The India International Bullion Exchange, or IIBX, was launched by the Prime Minister in July 2022 at Gift City. Instead of opaque consignment channels, qualified jewelers could import gold through exchange traded contracts. So that would mean prices that would be visible on an order book. From launch through March 2025, IIBX traded a cumulative 101.4 tons. It projects 120 tons for FY26. India imports 800 tons a year and IIBX handles roughly 15%. The other 85% still flows through consignment. Now, the problem is incentives. For the foreign supplier, consignment gives guaranteed market access without price competition. For the bank, it's risk-free income. For large dealers, OTC means preferential pricing that smaller players can't access. Transparency is not in anyone's commercial interest except the small jeweler at the end of the chain who has no say. China faced the same problem. Before 2002, its gold market was opaque. The People's Bank of China established the Shanghai Gold Exchange and mandated that all gold flow through it. Today, the SGE is the world's largest physical gold exchange with over 2 million individual investor accounts. It runs a twice daily benchmark auction in RMB. When Chinese demand surges, the Shanghai premium spikes and traders worldwide respond. China has a voice in global gold pricing. But India built the exchange but didn't mandate its use. Meanwhile, India's gold imports often clashed with India's political economy. Between 2012 and 2013, gold imports surged so dramatically that they became a threat to macroeconomic stability. The current account deficit was ballooning, the rupee was falling. The government hiked import duty from 2% to 10%, and predictably, smuggling came roaring back. Seizures in the first quarter of 2013-14 were 365% higher than the 365 days before. Alongside the duty hike, the RBI tried the 80-20 scheme, where for every lot of gold imported, at least 20% had to be made available exclusively for jewelry exporters. Only after proving that could the bank release the remaining 80% for domestic sale. The idea was to ensure gold imports generated some export revenue and therefore foreign exchange. But in practice, it created enormous confusion, was vulnerable to round tripping, gold exported on paper to justify more imports, and was withdrawn in November 2014, less than 2 years after it was introduced. Then, in the July 2024 Union Budget, the government slashed import duty from 15% to 6%. If high duties caused smuggling, lower duties would bring imports back into official channels. It worked in the sense that official imports surged. But it worked too well, inflating the import bill massively. Meanwhile, traders kept finding loopholes. Some discovered they could import gold jewelry through Thailand at zero ASEAN duty. Others found they could import gold disguised as platinum alloy from the UAE at lower duty rates. This week's two DGFT notifications are aimed at plugging these, and they'll work for a while, until someone finds the next one. Now, this week's restrictions will close some of these loophole routes, but the core of the situation doesn't lie there. India's gold market is worth over $69 billion a year. The RBI holds a record 880 tons in its reserves. Nearly 10 million Indians hold gold through ETFs, tens of millions more buy it physically every year for weddings and festivals and as savings. And all of this runs on a price set in London, imported by 16 banks that don't actually buy the gold, sold through private calls to a few hundred dealers who each get a different quote. The fundamental problem is that India's gold market is quite opaque and has less reason to be less so. Now coming to the tidbits. SEBI has extended the validity of IPO and rights issue approvals till September 30th, 2026, giving companies more time to launch offerings. The move comes amid West Asia tensions, market volatility, and weaker investor participation, with no penalties for delayed compliance during this period. Coming to the next tidbit. The RBI has projected FY27 GDP growth at 6.9% and inflation at 4.6%, while keeping the repo rate unchanged at 5.25%. Growth remains steady but slightly lower than last year, with risks from geopolitical tensions and energy prices. Inflation is expected to stay within the target range. Coming to the final tidbit. Gautam Adani has asked a US court to dismiss the SEC's fraud case, arguing it falls outside US jurisdiction and shows no wrongdoing. The case relates to a 2021 bond issue by Adani Green, with the group denying all allegations and saying investors suffered no losses. That's all the news I have for you. Thank you so much for watching, and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.